This is the kind of ICT entry model that doesn't fail, and most ICT traders fail to understand this simple concept. I'm about to show you something that will change the way you look at your chart and the way you trade using the ICT concept. So a typical ICT trader, whenever you come to your chart, what you look out for is to look out for the order flow and to look out for the most recent price action to know exactly what price will be doing. For example, this is a short-term uptrend. We have a break of structure right here, picking out external range liquidity, retracing back into this area of interest, or what we call point of interest. It can be a fair value gap, it can be an order block. As you can see, where I marked this order block is the extreme, where price is expected to come for a typical ICT trader. But let me show you a better way to do this, because this is what happens most of the time. You look out for your point of interest and you wait for price to come to this area, which is an order block, and mostly your stop loss is below here and your target is right up here, right? So let me show you what happens most of the time. If you wait for price to actually come to that area, price never really came back to that area, this point of interest. And this is what makes it more frustrating to a lot of ICT traders. Let me show you how to get this entry without even waiting for price to come to this point of interest. So how I normally go about it is to use this concept I call the 2 time frame rule. What that means is that after you have successfully selected or choose your time frame of interest, for instance, this is the 1 hour time frame that I'm watching, I marked out my point of interest and most important areas in the 1 hour time frame. I will now watch out for this retracement, which you see right here, in a time frame lower than this. Now, a time frame lower than this can be 15 minutes and can be 5 minutes. For this case, I have the same chart, the same currency pair, but this time around, this is in the 5 minute time frame. Ideally, if you're trading ICT concept, this is how you go about it. You watch out for this price action, and if price is going bullish, with your Fibonacci tool, you measure from here to here. And the most important aspect of this movement is the discount area. Below the middle line is called discount, above the middle line is called premium. And it is best when you take trade from discount right here. This is the best way to go about it. You cannot be taking trade from a premium if you are going bullish or if you are buying in this kind of market, because this is more riskier, because price can eventually push down to discount. And that is exactly what I'm about to show you. In the 5 minute, this is how you're going to watch out for the price action that will give you that entry. Now, this is the correlation you have. You have an uptrend from this higher time frame, and the retracement is obviously going to be a downtrend. In the lower time frame, you're going to watch out this retracement as a downtrend. So this is why I decide to come to the 5 minute, knowing that this is the point of interest. Price can eventually go there, or price cannot even go there, and that is why I'm using the 5 minute to watch it out. So let's watch out and see how this retracement will come in. I expect to see price do something like this, retracement coming in. All right, all this is a downtrend, but at a point when I see price crashing and changing direction in the lower time frame, giving me this shift in market structure, as you can see right here, it means that this downtrend, which is the retracement, is coming to an end. I call it market structure shift. Other people call it change of character, but this is what ICT call it, market structure shift. So in the lower time frame, I expect to see this kind of movement, and that is exactly what I'm expecting to see. In this kind of movement, if price gives you this, after this market structure shift that we saw right here, we will see price coming back to either an order block or a fair value gap, and that is when we are okay to take a trade right here. And then we go on. We do not just blindly take trade from the 1 hour time frame, which we had right here. We don't just blindly wait for price to come here. This will give us a whole lot of information concerning the retracement, and that is exactly how to take a trade using this concept. So in your retracement, you're going to watch it out. Can you see price coming back? You're going to wait for a shift in market structure in a discount area since we're going bullish. Even if I have a shift in market structure in the premium area, which is right here, because I'm not taking trade here, it is not going to be attractive to me. But if I see any shift in market structure in the discount area, that is the best way for me. So I'm going to watch for this retracement to come into that area. As you can see, I'm just playing it out for you so you can see. So look at this. Did we see a shift in market structure in the premium area? This is a shift in market structure right at this point because price was coming and we closed above the recent lower high, which is right here, which is an indication that we have had a shift in market structure, an alignment between the higher time frame movement and the lower time frame. Why am I not taking this trade? I'm not taking this trade because this shift in market structure actually occurred in the premium area. At this point, you can actually see if you pick your Fibonacci tool, put it right here, and then take it up to this level. This happened around premium area, so I'm not interested in taking that trade. I want to see it happen in a discount area. So we go to the discount and see if price can eventually come, and this is why you need to be very patient and watch out for price to do whatever it wants to do. Let me just play it out so you can see how fast this can go. So you now see this is the reason why you don't want to take trade in the premium area, because price can eventually take you out. So if I see shift in market structure now in this area, the discount area, I will be very happy to take the trade. So we watch out for what is happening right here. And it's okay. This is what I want. A shift in market structure actually occurred right here. Can you see? Price was coming just like the movement I gave you right there. Movement, you have this movement, you have this movement, you have this movement, and then you have this shift in market structure right at this point. And this is what we have also right here. A shift in market structure. That is an indication that price is obviously going to change direction. Remember, our overall movement was a bullish movement and the retracement was a bearish movement. What if the retracement later turns to a bullish movement? That means we have an alignment. So if price comes back to an area of interest right here, let me show you. So we can have different area of interest right here. This is different models right here. This is an order block right here. This small candle is an order block. And then this guy is a mitigation block. If you want to learn all these terms from ICT, I have a complete video where I explain all these things on my YouTube channel. Just go through my YouTube channel and you're going to find all of them. So this is it. I marked this as my point of interest. This particular red candle with this confluence, I'm seeing a mitigation block and this particular candle. So if price is to come back to that area, that is the best place for an entry. Your entry is here, and then your stop loss is just below here, and your target is the opposing liquidity up there. That is how to have an entry using ICT concept. All right, you now see you don't have to wait for the point of interest right there, but let's play it out and see how price actually played out in this kind of movement. Yes, you can see in the trade already, your stop loss is just below here, having some kind of a chunky movement, and then you're going to watch out for price to play out and see how effective is this entry model. Okay, so you can actually see that when you use this kind of entry, you stay away from a hilarious risk. Look at the risk. This is almost 1:5 or 1:6. in that movement and you target the opposing liquidity, and that is exactly how you go about it. You target the opposing liquidity and you are good to go. You can see that price have reached almost your target, if not your target, from that movement. I hope this video is helpful enough, showing you the best entry pattern. You don't want to enter from the same time frame that you mark out point of interest and you're waiting for price to come down here, and that is the mistake of so many ICT traders. I hope this video helps you a lot. Thank you guys. I actually made this video because so many people reached out to me to re-explain some of the videos I've made concerning an entry. Thank you guys for watching. See you in another video.